Hello and welcome to another video weekly market commentary. I'm here with Alisha Norris, again, our senior portfolio manager. And today we want to talk about the crystal ball, right? Joke, obviously, because it doesn't exist and we have no shame in admitting we have no idea what the immediate future looks like. But there is a whole slew of analysts in the industry whose whole job is to make predict a better future or predict what the crystal ball is going to yield. And one of the things we want to talk about today is what that data entails, what it reveals for potential outcomes over the next 10 to 15 years, with the knowledge base that the vast majority of investors do have a 10 to 15 year horizon, if not significantly longer. So let's just start real quick by checking our own biases at the door and saying, what's been the best performing index of the past 5-7 years? And maybe why that's happened, Alisha.
By far, the best performing index is the S&P 500, and that is the case because the U.S. has outperformed international and emerging markets, and the fact that in the U.S. we have a huge bias towards tech, and those mega cap tech names have really outperformed other sectors.
Yeah, it's been that overvaluation story of the past 5 to 7 years when we have the notion of your Apples, your Googles, some Netflix, Teslas have been in there, not necessarily tech, but might as well be a quasi-tech company that have completely expanded that market cap weighting of the S&P 500, right? The bigger the company, the bigger the weight, the bigger the return, the bigger the outcome. So when we look at that on a forward-looking basis, when we track how the markets are behaving now, 2022 was a great year to see that happening amidst rising interest rates. Give us an understanding of what do the big banks on Wall Street in general, right? And in this case, we tracked JP Morgan, Morgan Stanley, Goldman Sachs, Wells Fargo, Bank of New York, Charles Schwab, Invesco, the biggest names that employ all the crystal ball analysts, so to speak. What does that outcome look like potentially for the future?
Sure. So the six most prominent asset classes are in table 1 of this one pager.
Yep. And we'll share this on the commentary.
Yep. So the first 3 are U.S. equities by market cap, so large cap, mid cap, and small cap. And over the last 15 years, significant outperformance in the U.S. versus international equities. When we look on a forward-looking basis, based on these capital market assumptions of these large firms, there's going to be a role reversal here where international equities are going to outperform domestic equities per these expectations. So this is a huge shift, especially for those portfolios that have a significant home country bias.
Yeah. What's funny here is it's hard for us to grasp the fact that international could outpace U.S. But if we track the period from 2000 to about early 2008, international markets outpaced the S&P 500 by 5% annualized, nearly 5% annualized during that time frame. So it's not unrealistic to see that cycle shift amidst rising interest rate environment, amidst a backdrop where now fundamentals matter once more, right? Amidst this no zero interest rate policy. What's most interesting about this data is the expectation for aggregate bond returns, fixed income, right? Walk us through that a little bit because I think that's fascinating relative to where rates are at right now.
Sure. So in the past 15 years, total returns have been around 2.9. If we would have run this analysis at the end of 2021, we would have saw a vastly different performance than this 2.9 going forward. It would have looked like maybe 1% or something like that. But because interest rates have risen and bond prices have performed terribly in 2022, it does set us up for better returns going forward for bonds. Yet when inflation is running at 7% and we're thinking it's going to remain higher than the Fed's 2% target, a 3% total return is not fantastic given inflation. Yeah. So we're looking at fixed income more as a diversifier rather than something that is going to enhance our returns going forward.
Yeah, well said. To put that in further perspective, the bond market was down roughly 12-13% last year in 2022, that is, with these expectations of roughly 2.9 to 2.8% for the next 10-15 years. Mathematically, it would take roughly 5 years or so for the bond market to become whole again from the aggregate losses of 2022. So not really a great source that we would seek total return in there. And as a result of that, we do favor equity market participation notably better than fixed income in this case. And we look forward to kind of adjusting and taking advantage of opportunities in that process.